Okay, good. So let's go ahead and let's take a look here at this number 10 now. And what do we got going on here? We've got this Pat Weaver Inc. issued 10% $1 million bond for $1,116,000. And they retired all of these bonds on January 1st, 2018 at 102. Unamortized premium on that day is $92,800. How much gain or loss? Okay, now first thing is to figure out the cash that's going to come out of this. If it's $1 million face and they tell us that they retired it at 102, we're going to take the $1 million face. Okay, we're going to take the $1 million face, and we're going to multiply that by what? We're going to multiply that by 1.02. That's going to give me 1,020,000. Okay, so they got this 1,020,000. That's the cash that they're getting. They're going to get that cash. So when they call the bond at 102, the way you get the cash is to say the 1 million times the 1.02, that's 1,002,000 with me so far. Okay? Now we have to figure out the carrying value of the bond. And the carrying value of the bond is going to be this, what, $1 million face. And did they tell me what the unamortized premium was here? Is 92,000. So I add 800. So I add the 92,800. So now the carrying value of this bond was 1,092,800, right? So what's happening? I still owe 1,092,800 on this bond, and I'm able to what? Call it for less than that. Is that a gain or a loss? Huh? No, it's a gain. If the bond is what? At 1,092,000, that's sort of saying that's what you have to pay to get rid of this. And because of the covenant of the bond deal, I'm going to be able to get rid of it at what? Call it at 1,020,000. And literally take it off the books, right? Okay. And so what happens? That difference is 72,800. That is a gain, isn't it? Are we understanding the concept of why it's a gain? I would liken it to you have a mortgage, right? And the mortgage is 1,092,800. Yeah, 1,092,800. And the guy tells you, that's okay, just give me 1,020,000, we'll call it even. Well, that's what? That's a gain for you, isn't it? Okay? Okay, good. Now you come over and you take a look at number 11. And we see on January 1st, Tiny Tim Industries had outstanding $1 million 12% bond with a book value of $966,130. The indenture specified a call price of $981. So they're sitting here now and they're telling me, instead of making me calculate that call price, they're just telling me what it is. That's the cash, isn't it? Is that the cash? 981,000. Okay. Now, the bonds were issued to yield 14% on July 1st. Tiny Tim called the bonds on July 1st, 2018. What is the amount of loss on the early extinguishment? So if the bonds have a what? Have a book value of January 1st, 2018 of 966,130. Can I use that number to calculate the gain? Good. We've got what? We've got 6 months that's gone by, don't we? Okay, so what are we going to do? We're going to go ahead and we're going to say, well, okay, right now let's just look at what the carrying value, the discount right now. So right now the discount is how much? We've got 966,130 is the carrying value, and it was what? $1 million face. So if you take the million minus the 966,130, you get what for the discount? 33,870. Right, guys? 33,870 is what's showing in the discount account right now, right? Okay. Now, if I were to make the balance sheet right now, this is at January 1st, the balance sheet would show bond payable of $1 million. We would have discount of 33,870. And of course, the carrying amount they already told us is 966,130, right? That's the carrying value of that bond. Now, they tell me that I'm supposed to get a interest rate of 14%, right? So if I want to figure out the interest now, what it should have been for those 6 months, it's going to be calculated by taking the 966,130 times what? 966,130 times what? Good, times the 0.07, the semi-annual rate, right? And when I do the math on that one, I get this interest expense of $67,629. All right, but then to get the amount of discount amortization, I have to compare that to what? The actual cash interest. The cash interest is going to be $1 million times, what rate do I use? 6%, the 12% divided by 2, so that gives me 0.06. Good, so that's a $60,000 difference. Okay, so I mean not difference, but that's 60,000, and so the difference becomes this 7,629, right? Right? Okay, so I'm going to go ahead and I'm going to make this journal entry that they show us right here at that time.
Can you explain why we're taking 7% for the interest, not 6?
Because we calculate our interest expense on the market rate of interest. And so if they tell you it was set to yield 14%, or they tell us the market rate of interest was 14%, that's how we calculate the interest expense. The cash interest is set on the contract amount.
Okay, but why is that?
Because when we purchased the bond, we figured out the price of the bond using the market rate of interest, right? Okay, and so now when you figure out that interest expense each period and you compare that to the cash interest, what you're basically doing is unraveling that present value of the annuity table. You're going backwards on it now, period by period, and so it's going to end up being face at the end of this thing, right? Okay, and so we have to use the 14% to figure out the interest expense, right? Okay, and so we go ahead.
Question?
Uh huh.
I don't quite understand the very first sentence. What is the exact meaning of the 12%? What kind of rate is 12%?
12% is the stated rate, the contract rate. Yeah. So when they say had outstanding 1 million of 12% bonds, that's telling you that's how we communicate that that's the stated rate, right? Okay, so sometimes they'll say had a stated rate. Sometimes they'll just say $1 million of 12% bonds, right? Okay, now look, if you start to get confused which one's the stated rate and which one is the coupon rate, obviously the bond issued at what? At less than face, didn't it? This bond issued at less than face? So since this bond issued at less than face, then it had to be the case that what? that the market rate of interest was more than the stated rate, right? Right? Okay. Okay, so then we go ahead and we have this discount amortization that we just figured out, and we take that discount amortization, we credit it, don't we? Debit the interest expense, credit the cash, obviously, for the cash, and we need a, oh, come on. We need a what? We need a credit to make this journal entry balance. That credit goes to the discount, right? So we go ahead and we take that credit to the discount of 7. Man, this thing's annoying. Of what? 7,629, right? And when we put in that debit to the discount, now the balance in the discount account becomes, balance in the discount account becomes this 26,241. The balance. Guys? Is that the balance? Right? Okay. And so if that's the balance now, if I take the $1 million bond payable, and I have the discount, and I subtract, how much is the discount now? 26,241. And so now I've got a net carrying value on this bond. Carrying value of this bond has gone to 973,759. Is that correct? 973,759. Okay, so if you look at now, I'm listening for where we are in the problem here. Oh, I see. So if the carrying value was 973,759, and the cash that's coming out of this is 981, right? So you take that 981,000 is what they were buying this bond back for. That gives me a difference of 7,241. And that's a loss because I'm having to pay what? I'm having to pay more than the carrying amount of the liability. Therefore, that's a loss. So the answer is C here. Okay, now I went through this long process here to sort of show you how it would all work. We'd amortize the discount. Amortization of the discount would bring the discount down. That would bring the carrying value of the bond up, and that's what we had to get to, whatever its carrying value was at June, July 1st, whatever, when we were sitting here and calling this bond.
Why you write the 7,629 on the T table?
Why did I write it here? Because what did I do? I wrote these backwards. Is that what I did? I wrote them backwards here. Thank you. I should have debited the discount, right? At the beginning? Thank you. I should have debited the discount for the 33780, and I should then have credited for the 7629, right? Thank you. And that brings me to the debit balance that's left in the, thank you, that's left in the discount. Discount is a debit, right? Right? Bond payable is a credit, the discount's a debit. Okay, thank you. Okay, and so I have this 26,241, and then we went from there. Now, I sort of did this the long way just to show you the way this all worked out, but a faster way to do it would have been to do what? Once I figured out the amortization on the discount, shouldn't have I just been able to take the previous carrying value of what? 966,130, and if I add the amount of discount amortization, 629. Don't I get that new carrying value here of 973,759? I get the same answer, don't I? Okay, so like we've said before, you simply add the amount of discount amortization to get the new carrying value, right? The reason we add the amount of discount amortization is if we credit the discount, right, we bring the discount amount down. If the discount amount comes down and the discount is being subtracted from the bond, then the carrying value is going to go up by the amount of the discount amortization, right? Right? Okay, and then that would have given me the new carrying value at the end of that 6 months, same number, and I would have just gone ahead then and subtracted off the cash that I'm paying, and since the cash is more, I'm going to have a loss. If the cash was less, I would have had a gain, right? Okay, good. Now we come over and take a look at the next question down. Okay, and we've got a couple of questions here now dealing with the accrued interest. So what happens here? Remember we said that if we issue the bonds in between interest payment dates, we do what? We collect any interest that is accrued for that period as part of the original payment for the bond, and then when we make our first interest payment, we'll return that money back, right? Along with any interest that is actually accrued from the date of issue to the date of that next interest payment. So you look at this question and they tell us that they issued 50 million of 12% bonds on April 1st at 98. These bonds are dated January 1st, 2018 and mature on December 31st, 2037. Interest is payable semi-annually on June 30th and December 31st. Okay, so let me ask you this. When would have been the last interest date before before April 1st? You can say December 31st, you can say January 1st, whatever, right? But that's what? That's how many months? All of January, all of February, all of March. Be careful. If you sit there and you look at April, you think 4 months, you're going to mess this thing up, right? So think through the number of months that we're talking about. Okay, so we're going to have to collect 3 months of interest that is accrued, right? Now, if they tell me that they issued the bonds at 98 and it's 50 million, I'm going to take this 50 million and I'm going to multiply it by what? 0.98, right? And that 50 million times 0.98, I can see kind of peeking out here, gives me 49 million, right? With me so far? But I also have to pick up what? 2 months of accrued interest. And so I take this 50 million and I multiply it by the interest rate of 12%, but it's for how many months? All of January, all of February, all of March, not April, right? And so I multiply that times 3/12. And just to steal the calculation, because I think it's right here, that's 1.5 million. Okay, 1,500,000. So I should be getting what? 51,500,000 or 50.1.5 million. 51.5 million. Huh? Oh, it's 50. Oh, sorry. 50. Well, that's not very nice of them. I put a number in there that I could have gotten by making a simple adding mistake, but that's all right. 50.5 million. So that's what? That's the issue price, which was at 98, plus the accrued interest, right? Question on that? Okay, I think the last one here is another accrued interest. What amount of cash did we receive on the bond issue? Is there any question on that? You want me to do it, or you just want to move on from that?
Can we do it?
Sure, we can do it. Okay, so let's go ahead and let's take a look at this one now. And it's bonds issued, and they pay interest semi-annually January 1st and July 1st. And the bonds were sold at face amount. Thank you. Since they were sold at face amount, I know I got at least $350 cash coming, right? Because they're asking me what's going to come in. But now I've got to get this accrued interest, right? And the last interest payment would have been on July 1st, and they're issuing the bonds on September 1st. So that's all of July. That's all of August, right? I'm telling you, count it out like that, guys. It is so easy when you're in a hurry on these questions to sit there and mess up the months. I think when I was looking at this a little earlier, for some reason, I put 3 months in there. So it's all of July. It's all of August. It's just 2 months, right? Okay. So we go ahead and we're going to take the 350,000 times 0.08. That gives me, no, I don't care what it gives me, because I still have to do what? Times 2/12. Okay. And let's just sneak down at the math down here just to give it to us. Of course, they never give me, I hate this. Why they don't show the number? I want them to show the number. What's the number? 4,667. Okay. 4,667 is what that equals. So the total cash includes the issue price plus the accrued interest. Okay. Question? Okay, good. Now, don't forget, guys, that, fair game for the exam would be what would be the next, when they go to make that next interest payment, what would they do at that point, right? They would have to credit the cash for the actual cash, and they would go ahead and do what? Debit the interest payable at that point, and debit the interest expense for the remaining 4 months in this time frame. You want to do that? Okay. Let's go ahead and let's see what happens for those next. Let's go ahead and see what happens then. So now they're going to make the interest payment on what? We've got one coming up on, of course, great. Now it's got to go into September on me? No. We issued the bonds on September 1st. Well, I can't do it with this one very easily because I'm going to have to go to the year end. Okay, we'll just do the whole thing then. So what happens? We get to December 31st. What do we want to do? Well, we had issued these bonds on September 1st, right? And now we've got December 31st. Well, let's just make this entry here. So how much, I'm just going to come right here. So how much cash did we get? How much cash did we get? So we debit cash 354,667, don't we? Right? We credit the bond payable for what? 350,000, and we're going to credit interest payable for this 4,667, right? Okay. Now we come to December. That's not at December 31st. That's at the issue date. But now we come to December 31st, and we have to accrue the interest now from what? September, October, November. Okay, December, the remaining 4 months, right? Okay. So we're going to have to do that calculation, which is going to be 350,000 times, what was it, 8%? Times what? 4/12 now? Anybody got that number for me? The interest for the 4 months?
9,300.
$9,333? Like that? Okay, great, thank you. So we go ahead and at December 31st then we're going to debit interest expense 9,333 and credit what? Interest payable. I don't know why I'm writing that way over there. Credit interest payable for an additional now what? 9,333, right? Okay. I'm not going to change it now. It's 333,334, whatever, huh? Okay. Whatever. I don't care. Here, I'll give you the dollar. Okay, so what? We're sitting here and we go ahead and we debit the interest payable. We debit the interest expense, we credit the interest payable, right? So then what? Then we go ahead and we make that on January 1st of the next year. We go ahead and we make that interest payment, don't we? And right now our interest payable is what? The 933 plus the 4667. What's that? How much is that? 14,000. Okay, good. And the 14,000 would have come out by saying 350,000 times 0.08 times 1/2 should give me 14,000, right? That's a full 6 months worth of interest. Okay, so I go ahead and I'm going to do what? I'm going to now simply debit the interest payable for the 14,000, and I'm going to do what? Credit the cash for the 14,000, right? Now you're sitting there and you're saying, man, that's an awful lot to go through. I mean, why did they collect that 4667 up front? They're saving themselves the hassle of having to do what? Cut a different check to everybody. Everyone gets what? Exactly 14,000 every 6 months. It's easier for them from an accounting standpoint. Okay. When a company issues bond between interest payment dates, the journal entry, there we go. I guess it did help us to go through and talk about the journal entries there. There it is. It includes a credit to interest payable, right? Isn't that what we did right here? Okay. All right. I think that's enough of that. There's another question there, but I want to get us, let's take a quick break here, okay, so as we get a chance to take a break, and then we're going to get into that practice midterm, all right? I don't want to do that last one. It's more of the same, trust me. Okay? Unless somebody wants to specifically beg for that one. Okay? All right, we'll see questions like this on the midterm, but I want to get us into the practice midterm. Okay, guys, we'll take a break. So they came up with this fair value through net income approach, but if we're accounting for a dividend that way, of course we're going to do what? We're going to mark it on the balance sheet if it is a trading or available for sale. If it's a trading, unrealized holding gains and losses will go to my income statement. If it's available for sale, unrealized holding gains and losses will go to other comprehensive income, right? If it's what? Can't be held to maturity in this case if it's a paying dividends because it's a stock, right? So, but if it was a bond and it was held to maturity, there would be no unrealized holding gains and losses. So if they're telling me fair value through net income, basically they're telling me that we're treating that thing at fair value on the balance sheet. And again, if it's trading, the income's going to the income statement, unrealized holding gains and losses going to the income statement. If it's available for sale, unrealized holding gains and losses are part of my other comprehensive income. Anyway, we don't need to worry about all this here. Now we're dealing with the other part of the income on this, which is what? The dividends are treated as income here, right? Well, that's the longest answer to an easy question I've ever given. Okay? All right? Okay, you come over and you take a look at number 2. And when a debt security is appropriately carried and reported as a security available for sale, gains should be reported in the income statement when? Only when the security is finally sold, right? We would include it in other comprehensive income period to period. Other comprehensive income gets closed out to what? Accumulated other comprehensive income. And then when we finally sell the bond, we'll do what? We'll do a reclassification adjustment to take any unrealized holding gains or losses out of accumulated other comprehensive income, and we'll take it as what? Net income on the income statement at the time of sale.
Slowly.
Huh?
Can you?
Yeah. You want me to give you an example?
No, just.
Just say what I'm saying slowly?
Yeah.
Okay. If we're sitting here, and it's hard for me to talk slow, man. In Hayward, you got to talk fast. You're in trouble. Okay. So I'll try to slow it down a little bit, though. So what's happened? When I was in China, I was doing the presentation in English, and the expectation was that I thought, since I'm doing the presentation in English, everyone can understand me. I don't know if they're talking. And the people that had invited us to started holding signs up saying, slow down. It's hard for me to slow down. That's part of why I record them. But what happens? If we're sitting there and we have a available for sale security, right? As we have changes in fair value, we will go ahead and use our fair value adjustment account, up or down, say up, okay? And so we would go ahead and debit that, and we credit other comprehensive income because we're not selling the security yet, right? Okay. Then of course we close other comprehensive income to accumulated OCI each period, and that'll build up until we finally sell the security, right? When we finally, or it could go down, but let's just assume it's going up. When we go ahead and we finally sell the security, what are we going to do? Well, we're going to debit cash for whatever the amount of cash is that's coming in. But before I get to that, we're going to close that revaluation adjustment account, right? Fair value adjustment account, I should say. And so we would, if it had increased, we would credit that. We would debit the reclassification adjustment because we need to get that amount out of the accumulated OCI, right? At the same time, we would go ahead and do what? Debit the cash for the amount that's coming in, credit the security for the original amount we bought it for, and then credit real gain, net income gain in that case, right? Okay, assuming again that it went up. And then we close out the reclassification adjustment to accumulate other comprehensive income. That'll zero out whatever we had built up in there up until the time of sale. Okay, so when they sit here in this question, they say when a debt security is appropriately carried at available for sale, when a debt security is appropriately carried and reported as security available for sale, a gain would be reported in the income statement finally when it's sold, right? Okay, now on the test, I could sit there and I could have you running in and out of other comprehensive income, amounts going up, amounts going down, and have all kinds of fun activity there. And you could go the long way and try to put everything into accumulated other comprehensive income, and then take it all back out and try to figure out what the real gain should be on the income statement. Or if you wanted to, you would simply do what? Compare what you sold the security for what its original cost was. That amount will always be the gain, won't it? Okay. So that's it. Okay, unrealized holding gains and losses on security available for sale should have the following effects on accumulated other comprehensive income. Gains will do what? increase it, and losses will do what? Decrease it, right? Okay. Now again, these first 1, 2, 3 questions I think had the desired effect, which is to give us an opportunity to review what we talked about a little bit in chapter 12 as related to these securities, okay? More likely, you'll start seeing questions like this number 4 here, okay? Well, I take that back because this is now dealing with fair value through net income versus equity method, some of these questions. But we saw quite a few of questions where we're dealing with the available for sale and the trading and the in and out of other comprehensive income with the multiple choice questions from chapter 12 quiz. And we're going to see that our full-blown problem in this example will run us through more of that, okay? Now, do our free response. Now we're taking still chapter 12, but now we're looking at stuff that was more related to the difference between fair value through net income and the equity method. So Zwick Company bought 28,000 shares of voting common stock of Handy Company in January 2018. In December, Handy announced 200,000 net income for 2018 and declared paid a dividend, cash dividend of $2 per share on all 200,000 shares of its outstanding common stock. Stop. If they have 200,000 shares of outstanding common stock and I bought 28,000, what percent is that? Right there. Okay, there it is right there. That wasn't very mysterious. It's right there. It's 14%, right? Right? So should I use the fair value through net income approach or the equity approach? Fair value through net income. Remember, our rule of thumb is what? Rule of thumb is if it is not 20% or more, less than 20%. I shouldn't say 20% or more, because if we go to 51, we're going to consolidate, right? So if we're what, 20 to 49.99999, whatever, we would use what? Equity. If we're less than 20, we'll use the fair value through net income approach. And we're down here at 14, right? So if we use fair value through net income approach, are we going to take a percentage of their net income? That's what? That's the equity method, right? Under the fair value through net income approach, our revenue on this is purely associated with what? The dividends, of which if it's $2 per share for the 28,000 shares, that should give me what? 56,000? Right? Fair value through net income approach, when you're down below that 20%, you simply do what? You simply take the dividends as your income, right? Now let me ask you this. What if this problem said that same fact pattern, but it said that Zwick has significant control, influence over Handy. Now what should I do? Use the equity method, right? Okay, so be careful with that, guys, because there's a good chance I might do that to you on the test. I might give you the pleasure of sitting there reading the question, and they'll buy an amount that's under the 20%. You still, but if I say that they have significant influence, you're going to have to do what? Use the equity method, right? What percentage would you use? What percentage would you use? What percentage of the net income would you take in that case?
Percentage of the shares we own.
Yes, good. You still use the what? 14%, don't you? Okay, so we would take that part of the income. That's 200,000 times 0.14 is number? Huh? 28,000. Thank you. And so I have this, 28,000 is my share of their net income, right? So that's my investment income, right? So it would change the answer, wouldn't it? What else do you want me to do here? What if I ask you what's the carrying amount of the investment? Could we figure that out? No, because they didn't tell me how much they paid for this, so I can't tell you that. But if they had paid, let's say when they bought these 28,000 shares, just to make the numbers easy, let's say they paid $10 per share. So 200,000 times $10 per share, and I'm just assuming the problem would have given this to us in this example, is going to be what, $2 million for the investment? Right? And then I would do what? I would take this investment revenue and the full journal entries to debit the investment for 28,000 and credit the what? Investment revenue for 28,000. So now the investment revenue account has 2,028,000 in it, doesn't it? Right? I bought the stock for 2 million. I just debited investment, so it's 2,028,000, isn't it? And then they paid a dividend of 56,000, right? Or at least our share of it was 56,000. So what do you want me to do with that dividend? If I'm asking you to give me the investment account, what do you want me to do with the dividend? We subtract it. Okay, we subtract that dividend because what? That's a distribution of my earnings now, isn't it? Okay, so I subtract that 56,000 off. So if I had 2 million plus 28,000 minus the 56,000 would give me 172,000 would be the value of the investment now. Because they've distributed some of that investment to me. Okay? Question?
Yeah. Can you explain again why we are subtracting the dividend?
We subtract the dividend because when we take our share of the income, because we're saying, hey, part of that income was ours, doesn't the income increase the overall value of a company? Right? Just from a book value standpoint, it increases the overall value of the company, doesn't it? Okay, and so we're saying, hey, our share of that increased our investment by that share, right? But if the company goes ahead and distributes a dividend, doesn't a dividend decrease the overall book value of the company? Right, we're going to sit there and take out the cash at that point. So we're saying that what? Some of that has now been distributed through a dividend, right? Okay, and so we reduce our share by that part.
So in that case, the company is making less income than it is distributed dividend.
In this given year, yes, that's a good observation. And then I just came up with the, well, no, that's true, because it had what? It had net income of, I think what messed it up was 28,000 shares. Where did I come up with the 28,000? Right here. Okay, so it had 200,000 of income, and if it gave dividend of $2 per share, is that what the dividend was? Yeah, they gave dividends that were more than that year's net income, but we don't have to give a dividend every year. Dividend is not predicated on my income for the year, so presumably there would have been retained earnings that were in excess of this 400,000 total dividends that they paid out. Okay. Right? But yes, you're right, my retained earnings would have gone down this year, right? Yeah.
How do you account for the subtraction of the 5,000 with 56,000?
How do I account for it?
Yes.
On journal entry, you mean? I would just go ahead and I would debit cash, right? Because it's a cash dividend. $56,000 and credit the investment, right? Because I'm going to bring down the investment by the amount of cash. Okay. Question? Now that's what? Using equity method with the wrong percentage, right? If they don't call out the method to you, they don't tell you what method they're using, then you use that rule of thumb, the 20%, right? But if they say, or if they say that they have significant control, even though they're below the 20%, right? Could it be that we're more than 20% and we don't have significant control? Can we be more than 20% and not have significant control? Sure, especially if what? Especially if somebody else owns 40% of the stock and we're at 30 or something, then they're in control, aren't they? Okay. Another thing that can happen, I don't know that I'll have this in the test, but another thing that can happen is there could be some sort of receivership that's going on with this company, and then what? Then even though we hold, say, 30% of the stock, we're not in control. Somebody else is in control of that company if it's in some sort of receivership. So it has to be what? It has to be the what? The significant influence and control, right? Okay. Okay, good. So we come over and we take a look and we talk about using the following to answer 5 and 6. And so we have this $1,000, we purchased 1,000 Diamond Corporation bonds for $500 per bond and classified the investment as available for sale. The value of the Diamond investment was $600 per bond on December 31st, 2016. We bought it in 2015, and $650 on December 31st, 2017. And we say during 2018, Hawk sold all of its Diamond investment at $700. And they want to know what's the impact on the income statement, right? Okay, now, remember, I'm going to go through the journal entries here with this, just so we remember the way these journal entries work. But then I'm going to show you a quicker way to answer this question than the way we're doing it by going through all the journal entries. So when they buy the security, right, in 2015, I'm going to put 2015 up there because I don't need a lot of room for 2015. When they buy the stock in 2015, they would simply debit the investment for, what is it, $500,000 in credit cash. $500,000. And then I'm going to go ahead and I come to the end of 2016. I'll put 2016 over here. And they tell me that at the end of 2016, the investment is $600 per bond, so it's gone up, right? So I'm going to go ahead and I'm going to debit my fair value adjustment for what, 100,000? And I'm going to credit unrealized gain for 100,000, right? Okay. Now I'm going to go ahead and tee up on the board here. My fair value adjustment, and right now I just debited for 100,000, didn't I? Okay. Now I need to, at the end of the year, this is unrealized gain. What type of gain is it? OCI, because this is an available for sale security, right? So then at the end of the year, I will debit unrealized gain to close it for 100,000, and I'm going to credit what? Accumulated OCI, AOCI, guys, for 100,000.
Why you would have to close the unrealized gain account?
Because it's a gain account. Okay, it's a what? It's a temporary account that's reported on the. It's not on the income statement, but it's on the statement of comprehensive income, right? And we close out all income statement accounts. It's a temporary account. The only account you don't close are balance sheet accounts at the end of the year, right? Okay, and so I go ahead and I credit it over to my accumulated other comprehensive income. So my AOCI, I'm going to credit for 100,000. With me so far? That's year one. Okay, 2016. Then what? In 2017, they tell me that the thing is worth 650. Has it gone up again? Right? So I'm going to debit my fair value adjustment. Let's just start abbreviating that FVA. Is that an okay abbreviation for that? FVA, okay. I debit my fair value adjustment for $50 more, right? 50,000. And I credit what? I credit unrealized gain OCI, right? For another 50,000. Okay. And so let me just go ahead and tee those up. I'm going to debit my fair value for 50,000. Am I going to close unrealized gain OCI for the next year, 2016? Am I going to close it?
No,
Why?
because we sell in 2018.
So, I still have to report 2017. I can't get to 2018 until I finish 2017, right? I'm going to have to prepare statements for 2017, right? So I need to close out. I close out my income statement accounts every year, right? At the end of each year. So I go ahead and I'm going to debit the unrealized gain for 50,000. That's the OCI. And I'm going to debit accumulated OCI, right? I know it's hard to see, guys, so go by the sound of my voice more than what I'm writing. I'm debiting unrealized gain 50,000. I'm crediting accumulated OCI for 50,000. I'm doing the same thing I did up here. It's just the next year now.
Why
Yeah.
don't we directly debit the FBA and credit the OCI?
Because to prepare our financial reports, we need accounts, don't we? When we prepare our financial reports, we make journal entries in our general journal, debiting and crediting, and then we post them to accounts, don't we? And then we pull the amounts from the accounts to generate our financial statements, right? And of course, we just don't have one transaction. We could have several transactions, so we accumulate all that in OCI gain. We see what it is. We pull it onto the financial statements, and then once we're done, it goes back to zero because we keep track of our temporary accounts by year, don't we? So this is how we turn it back to zero, and this is how the balance sheet ends up balancing too, right? Okay, and so I go ahead and I credit OCI gain the next year for 50,000. With me so far? Okay. Then I go ahead and I sell this thing for 700,000. And if I'm selling it for 700,000, did the value go up again? Value went up another what? 50,000, didn't it? Okay, so at that time, I'm going to go ahead and I'm going to debit FVA for another 50, and I'm going to credit the unrealized gain for OCI for another $50,000, right? For another $50,000.
That's in 2018.
Now we're in 2018. So I'm bringing the security. Yes, let me put that. That's 2018. And so I'm bringing the security up another 50,000 here now, right? In 2018, and taking my OCI gain, so that's 50,000. Okay. Now I'll come to the end of the year, and I'm going to close that OCI, right? So I'll debit OCI gain for 50. I'll credit what? Accumulated OCI for 50.
Which we're calling OCI gain is unrealized gain.
Huh? Yes, it's OCI, other comprehensive income gain for 50,000. I'm closing this unrealized. I should call it correctly. That probably gets confusing. It's the same account that I had just credited a minute ago. I'm going to debit now. It's unrealized gain OCI. I'm simply just zeroing this out at this point. Okay, and the main thing I want to do is I want to get this 50,000 in accumulated other comprehensive income, right? And now I'm selling the security. Am I selling the security now for 70,000? For 700,000? And so I'll put that on the board. If I'm selling it for 700,000, do I have cash at 700,000? Do I have cash at 700,000? Okay. I can now get rid of the security, so I'm going to credit the investment for what? 500,000, right? Because I'm selling the investment. And now I can credit what? Realized gain for 200,000. That's reported where? Income statement, isn't it? You can't see it? I'm going to go ahead, I'll put it right here. I'm going to go ahead and debit. Can you see it over here now? Guys, you can see it? I'm going to go ahead and I'm going to debit cash for 700,000. I'm going to credit the investment for 500,000. And I'm going to credit realized gain for what? 200,000. And realized gain is reported where? On the income statement, isn't it? Because I've actually sold that security now. Right? And then, of course, I have to do what? I have to close this fair value adjustment, and I have to get something closed out of my accumulated OCI. Right? And so what I'll do is I'll credit fair value adjustment, if I can reach it, for what? 200,000? Did I just close this out? Is this zeroed out now? I credit fair value adjustment for 200,000, and I will debit reclass adjustment for 200,000. Holy Toledo. I'm too old for this. Okay. I'll debit reclass adjustment 200,000, right? Right? And then I take the reclass adjustment and I will credit it to close it because it is reported by year for 200,000. That's closing what I just put up there. And I debit what?
AOCI.
Accumulated OCI, AOCI, that's right. I debit that for 2. And when I debit that for 2, this is out of here now, isn't it? And I want it out of here because what? This is headed for retained earnings, isn't it? Right? That's it. That's the whole thing that would have happened for this, right? Now, question on that? Now let's look back at the problem. What were they asking us? In the 2018 income statement, what should we report a gain as? A gain of what? 200,000? Did you have to go through the whole life cycle of journal entries of this thing to be able to answer that? You simply would have been able to do what? You would have been able to say, well, look, I know that they're going to have to report on the income statement the gain, the difference between what they sold it for and what they bought it for. It ultimately goes to the income statement, doesn't it, once I sell it? Okay. And then when you look at number 6 here, they say if Hawk recognized holding gains and losses up to the moment of sale, which we did, we took it up to 2018, what would be the amount of reclassification adjustment? And that one's just as easy, guys, because what? Once I've built amounts up in the accumulated other comprehensive income, and by the time I'm selling it, it's the difference between what I bought it for and what I sold it for. And when I sell it, I have to do what? I have to pull those amounts out, don't I? So the reclassification adjustment is also going to be the difference between what you bought it for and what you're selling it for, right? Okay? Okay. Number 7. If you have a question, you need to stop me. Do you have a question? Okay. Revenue from gift card breakage would be recognized when what? This is kind of a redundant question because what? If it's breakage, that by definition means that the probability of collecting is remote. That's kind of redundant. I mean, that's what breakage means, but anyway. Okay. Okay, good. Number 8. Clark Chemical Company received refundable deposits on returnable containers in the amount of $100,000 during 2018. 12% of the containers were not returned, and the deposits that we received are based on the container marked up of 20%, and they ask us what's the cost of goods sold. Okay, now what's going to happen? We're going to go ahead and we're going to set this up by saying that we have $100,000 for the deposits on the containers, and we have 12% of the containers were not returned. So that's giving us what? 120,000? I mean, no, 12,000? 12,000, right, that hasn't been returned yet. Okay. And since they're not going to return them, we're going to be able to take revenue for those parts that aren't returned yet. So we would go ahead and we would debit the liability container deposits. Well, first of all, let's do the whole thing just to make sure we're clear on this. We would have debited the cash. I just want to back up. We would have debited the cash for what, 100,000, and credited the container deposits. That's a liability, isn't it? Container deposits for 12,000. I mean, 100,000. Okay. And what? If everything but 12,000 was returned, that means 100,000 minus the 12,000 that haven't been returned yet. They must have returned 88,000, right? Okay. So I would debit the deposits. Debit deposits for 88,000. Credit cash, right? The people brought the things back, right? Okay? And now I'm sitting here and I still have left to go 12,000, don't I? Okay? And for 12,000 of this now, they didn't return it. So I'm going to keep the deposit. So I'm going to go ahead and I'm going to debit deposits for 12,000. That closes that out. And I'm going to credit container sales, whatever. For 12,000. Right? Now, I also have to reflect that I have a cost associated with those, don't I? And they told me that it was a 120% markup. Okay? So that means that what? Deposits equal what? My cost times 1.20, doesn't it? Right? If they marked them up 20%, then that means that my deposit is equal to the cost times the 1.2. Okay? So if my deposits are 12,000, then I go ahead and I divide that by what? By this 1.20. And that should equal my cost of goods sold. And I guess that comes out to 10,000 is the cost of goods sold. Okay. Okay, good. All right. Let's take a look at number 9. And we didn't have a lot of these in our chapter 13 quiz. Let me do something real quick that I think will help us. I think we should review this real quick, just as we didn't have a lot of questions from chapter 13 before. It dealt with the contingent liabilities and stuff. So I just want to get to chapter 13, 12, 13, where are you? I'm not going to put it in slideshow mode. This is too much trouble, and I think we'll be able to see it. Okay, so right here. So we take a look here, and remember we said that if a loss is probable and estimable, we are going to do what? We'll make an accrual, and we'll have to disclose what was going on about that accrual. Okay? Or if it's known, or obviously if it's known, it's estimable. If it's probable, then what? Then it is not. If it is probable but not estimable, then I will only disclose, right? Okay. And then if I have reasonably possible, I just have to disclose, and if it's remote, I do nothing, right? Okay, I don't have to disclose, nor do I have to accrue. Okay, so now, coming back to this question, these people are involved with something with the EPA, and the EPA is penalizing them, okay? And does the federal government have the right to penalize you? Can they penalize you? Oh, yeah. Yeah, especially if you got the Marines and the Navy on your side, right? You can do pretty much whatever you want, okay? So what happens, we go ahead and we're going to penalize, and they're penalizing it at December 31st, 2018, and the environmental attorney for Raymond indicated that an unfavorable outcome of the dispute was probable. The additional penalties were estimated to be $770,000, but could be as high as $1.17 after year end. But before the 28 statements were issued, Raymond accepted the settlement of $900,000. So now we've got what? We've got a known amount, don't we? Okay. And what happened? Even though the additional information didn't come until that subsequent period between the end of the year's financial statements and the release, it was what? Something that was already in place at December 31st, wasn't it? And now we just have better information. So if that's the case, we need to do what? We need to use that better information, and we should go ahead and accrue and disclose, shouldn't we? Right? Okay. So we go ahead and they say, what should Raymond report as an accrued liability? They'll debit a loss, $770,000. They'll credit the liability for $770,000, right? Right?
How could he have known that settlement would be 900,000?
They settled. They settled with the EPA in February of the next year. Huh? Was it February? When did they say they settled? After year end. Oh, they don't say February. I'm making that up. They say before the issues of the financial statements, they settled, right?
Oh, so the question is, what should appear on the financial statement?
2018 statements, that's right. And even though the final settlement didn't come until presumably sometime in 2019, we still booked that because what? The conditions were in place prior to the on or before the balance sheet date. Okay? Now, if they told us, and of course the case wouldn't go this fast, but let's say EPA comes up and says, hey, you're fined. And we make all that, and they tell us about that in what? They tell us, well, I don't know how that would work, to be honest with you, because we must have done something before 2018. So I want to make it more of a sudden impact. A building blows up, okay? And the building blows up in 2019 before we issue the financial statements. Remember, because the events were not in place at 2018, that one we would simply disclose, right? Okay? Okay, good. Now we come over and we say number 10, a company should accrue a loss contingency only if the likelihood that the liability has been incurred is what? Probable and estimable. If it's probable but not estimable, we will do what? Disclose. Okay? Okay, good. Let's take a look at this one. And we have this web company has outstanding 7%, 10-year, $100,000 face value bond. The bond was originally sold to yield 6%. That's the what? That's the effective interest method, isn't it? That's the what? Stated rate? The 6%? No, it's not. You're right. That's the market rate. Thank you. Okay. Yeah, because it's what? It's a yield when they say that, and what? It did sell at a premium, right? And so since it's sold at a premium, we know that the stated rate has to be higher than the market rate, right? Okay, thanks. Okay. So they say that on June 30th, 2016, the carrying amount of the bond outstanding was $105,000, and then they want to know what the unamortized premium should be. What is that? 1 year? Is that 1 year later? They tell me what it was at June 30th, 2016, and they want to know what it should be. How much later? Guys, are you just tuning out on me? Is that what's happening now? Because I'm telling you, I know how to do this question already. So if you're going to tune out, let's end it. Okay? We're focused. Okay? So is it 1 year later? Okay? Between 2017, June 30, 2016, and June 30, 2017 is 1 year, isn't it? Okay? So if we're sitting there and we've got this 1 year, then we're going to figure out what the interest expense is for 1 year. The actual interest expense is going to be calculated using the 6%, right? So if I take that 105,000 times the 0.06, I get 6,300, don't I? Right? But how much would the cash interest be at that 1 year mark? That's going to be for 1 year. 100,000 times 0.07, that's going to be 7,000, isn't it? Okay. The difference here, therefore, is 300 that we've amortized off of the premium. So if the premium has come down, 700, sorry. Thank you. It's 700 that we've amortized the premium. And so since the premium has come down, then the carrying value of the bond will go up, but they didn't ask me the carrying value of the bond. They asked me how much is the premium now. And so if the premium was 5,000 and I've just amortized it 700, now the premium should be 4,300. Should be the answer to this question. Okay. Okay, guys, now that's a CPA exam question. Don't forget that I have access to CPA exam questions, and I will be throwing some on your test. Not from the test bank, from the CPA. It's going to be from the CPA. Not that I have the entire CPA exams test bank. I wish. The AICPA, the CPA exam was disclosed from whenever it started until 1996. When I took the CPA exam, I walked out of the exam with the test booklet in my hand. Okay? Since 1996, they have not disclosed it. They hide the questions. But some of the questions that they had originally disclosed are still in circulation, right? So for some of those questions, I'm going to go ahead and select some of those so that you can kind of see what CPA exam questions actually look like. Ones that you may very well see the same exact question on the test someday if you really take CPA. So we might as well practice to that level. Okay. All right, good. Let's take a look at this one. And we have this 300,000 is the maturity, and it's 12% bonds for 300,000. So we issued them at face, didn't we? Okay. And so if interest is paid semi-annually, what is the interest at September 30th? Well, if you issue the bonds on what day of the issue? Oh, wow. Probably in 3 months. January 31st. Oh, I know. Because they had what? They had made an interest payment at June 30th. I scared myself for a second. Since they had made an interest payment at June 30th, and then we're going to accrue interest from what? July 1st, essentially, till what? September 30th is what they're asking me in this question. So it's all of July, all of August, all of September, right? Yeah, that should be, that would be weird. That should be what? 2017. And again, like I told you, I steal these from the CPA exams. It's been around for a while. Okay, so September 30th, what? 2017, thank you. And that's 3 months, right? Okay, so 3 months times the 12%, 300,000 times 12% times 3/12 is 9,000, right? Okay. All right, let's take a look at this one. And what should be my interest expense? And we're sitting here and we have this 194,000 that they issued the bond for, and we want our interest expense for 1 year, don't we? And we're using what method here? Straight line, so that should be pretty easy for us, right? 200,000 minus the 194,000 means we've got a $6,000 discount. and we're going to amortize that over how many periods? 5 years. So 6,000 divided by 5 gives us what? How much? 1,200? 300? 12, right? Huh? What am I doing wrong? 6,000? 1,200? 1,200? The 1,200? Okay. So we got 1,200 per year, right? Okay. But then we have to figure out our cash interest, don't we? To get our total interest expense. Okay. And so my cash interest is going to be 200,000 times, and I have to use a stated interest rate, 0.075. And so what's that give me? 15,000? Okay. So if you take the amortization of the discount using straight line plus the cash interest, the answer here should be 16,200. Okay, this is straight line now, right? Effective, we would have had to look at the difference between our cash interest and our effective interest. Difference would have been the amortization of the discount, and that would have been added to my cash interest, right? Here, it's easier. You simply take the total discount, amortize it over the period the bonds are outstanding, and that will give us the interest expense. Okay. All right, let's do this free response question, and let's get out of here. Okay, so we've got what? We've got them making investments. We have these different dates here for the different investments, and the question now wants you to make journal entries for those transactions. I don't know that you have to show calculations, okay? But let's just go ahead and let's take a look at these transactions and see if we can figure out the journal entries, okay? So we say that we purchased 500 shares of medical company common stock for $20 per share plus a brokerage fee of $100, okay? And this does not represent significant influence. And that's going to be important because we know then that we should use fair value, right? Through net income method on this. Okay. So we look at that February 17th transaction, and that one's pretty easy. Other than the fact that we didn't talk about before, any transaction fees you have to pay are part of the cost of that investment. Okay. Anything you pay to secure an asset is part of the cost of that asset, right? Right? Yeah. If you buy a computer and you have to pay that disposal fee that they make you pay on a computer when you buy a computer, is that part of the cost of that asset? You can't get it out of there, out of the store, unless you what? Pay that fee. So all of that, all those things would be part of the cost of the asset. Okay? So you go ahead and you debit the investment account, right? Then they go ahead and they bought 30,000 shares of the 100,000 outstanding. Is that telling us what method to use? Good, very good. 30,000 of the 100,000, that's 30%. We're on the equity method for this one, aren't we? Okay. And they include on here that there's goodwill of 80. Now, that's a what? Mean trick in this question, because they're trying to get you to do something with the goodwill. And remember, we said that goodwill, what? Even though you can calculate it, it would only be brought onto the financial statements when we ultimately do the consolidation, right? Okay, so notice there's no entry for the goodwill. It's simply debit the investment, credit the cash. Now, we go to this June 25th transaction, and we got $1.20 per share of dividend from this medical company. Do we have significant influence over these guys? No, we do not. We do not have significant influence, they told us, for the medical company anyway, right? And so our income is simply going to be what? The dividend, isn't it? Right? So I simply take the $1.20 times the number of shares, which was 500, and that gives me cash, obviously, and gives me the investment revenue, right? I'll just highlight that. That one I don't even have to highlight it. Question on that? Okay. Then you come over and they want me to deal with this June 30th transaction up here. So it says Oldie Company reported second quarter profits of $20,000. Now remember, Oldie Company is the company that we just bought 30% of, and they reported second quarter profits of $20,000. Does any of that belong to me? Belong to 30%, right? So they simply take that $20,000 and they debit the investment account $60, and credit the investment revenue, right? For not 60, but 6,000 for our 30% of the 20. Okay. Then they go ahead and they purchase 2,000 bonds of Alpha Company for $15 per bond plus the fees. That's what? 30,400. Okay, so now what? Now we go ahead and we come to December 31st and they tell us the shares are selling for 25 for medical, and for Alpha, which is that one we just bought up here. Okay, and we're saying they're available for sale. We're using the fair value through net income method for those two, aren't they? So they give us the trading amount for those two. Notice, and I don't know why they didn't do this. They were being nice to you in this question. What would have happened if they would have given me the fair value of Oldie? What would I do with that? Notice they didn't give me the fair value for Oldie? Did they? No. They don't give me the fair value for Oldie. No. That's why I'm asking the question. They were nice to you by not giving it to you. If they gave it to you, you would have just stepped into the trap there, which is what? We carry the investment at what? Whatever we bought it for, our share of the income minus any dividends, that's what we carry the investment at. We do not mark it to fair value if we're using the equity method. Right? Okay, so be careful. If there's a question where they're using the equity method and they give you fair value, ignore that. That's a shark. Leave it alone. Okay? Okay, good. So we come over, and so we only need to consider the fair value for what? For those couple of ones. And so we would go ahead and calculate the fair value adjustment, which is now it's selling for $25 a share, the 500 minus what we paid for. That difference is going to go to, and for the medical is being carried using the well, I think they should have been a little more explicit here, guys. I mean, they don't tell us that they're using whether they're using they're treating it as trading or available for sale. Can't be held to maturity because it's stock. Notice they don't call it out. And the reason they're doing that is that the default, the fair value method is what you use if you don't know what category. You don't want to put it in trading. You don't want to put it in available for held to maturity. Available for sale is what you use when you don't want to put it in trading. You don't want to put it in held to maturity. Obviously, it's not held to maturity because it's a stock. And since they didn't tell us that they decided to put it into fair value, the presumption is that you default to what? Trading. I think they could have been a little more explicit if you told you they had decided to treat it as trading, or it may have been better to say they decided not to treat it as available for sale. If that's the case, then you know it's got to be trading because there is no held to maturity for stock, right? That to me would have been a fair way for them to say this, then make that a little bit overly hard here. But it's what? It's what we paid for it. Remember what we paid for it, right? And the difference between what we paid for that medical stock and what it's trading for now, which is this $25 a share times the 500 shares, that difference is going to go to the fair value adjustment account. We'll debit that. I'm going to erase these just so you can see this one better that we're talking about. We're going to go ahead and we're going to do what? We're going to debit that fair value adjustment account for that difference and credit unrealized gain, which is going to the income statement, right? Because we backed into it's a trading security. For that last investment of this company, Alpha Company, they told us it's what? Available for sale. And we purchased them when we bought them on October 1st for $30,400, didn't we? But now they're trading at $12 a share, aren't they? Okay, so it's what we had originally bought them for, which is the $30,400, and we're subtracting that off of what they're selling for now. And so this one has what? Lost some value. And so we credit the fair value adjustment for that, and we will debit unrealized holding loss, and that is OCI because it's available for sale, right? You mean, say that again? We had to debit the unrealized holding loss, OCI, for that. What did you want to do with the fair value adjustment? Okay. Question? Okay, so you can expect something like this. I'm not saying it's going to be a chapter 12, but something where I am giving you a set of facts and maybe I'm asking you for journal entries, or I could be asking you to calculate a series of numbers. So I could have asked you, for example, what is the unrealized holding loss at December 31st or something like that, and you would have had to have given me that number by being able to calculate these. Question? Okay, guys, if there's no questions, then we'll go ahead and call that a wrap. The exam, as I've said now, will be on Monday. We'll have the whole period to work it. So that's what, 2.5 hours to work it? I will start it at 10:30. If you get here at 10:40, you robbed yourself in 10 minutes. Is that your question? Yeah, if you get here late, that's less time, okay, because we've got to get out of here at 1. We're trapped by 1 o'clock, okay? So if you come in 10 minutes late, I'm not going to lock the door, if that's what you mean, you know, but you can come in, you'll start 10 minutes late, right? But I will hand the test out at 10:30. Okay, so that you have the full, 2.5 hours, and you're going to have to turn it in like pretty much right at 1 o'clock. I mean, you can turn it before, obviously, but you have to turn it in pretty much right at 1 o'clock, guys, because there's another class that's always rushing us out of here. I think you've noticed that, and I think they'll be here Monday, so we got to get out. You bring what? Skinny green Scantron. I held it up the other day. Anybody have a question on the Scantron? Bring that Scantron, bring your pencil, bring your calculator, bring your brains, bring scratch paper. If you want a couple pieces of scratch paper, you can have that. Okay, that's about it, right? No notes? Okay. All right, guys, we will see you on Monday. Study hard this weekend. This test is up on Canvas, and up on B courses, and I'll do my best to get the lecture up there today. Okay.
Question.
Uh huh.
Is that